While the content of this video has been reviewed by a certified student loan professional, it is for educational purposes only. Please take a moment to read the disclaimer. Now, onto the video. In our last video, we went over the two main strategies to save money on student loans. Those two strategies were, number 1, pay it off and minimize interest, or number 2, pay as little as possible and pursue forgiveness. Today, we will show you how these strategies actually work and how $250,000 of federal loans can cost $330,000 or $30,000, which is a $300,000 difference in the total repayment amount. If you took out federal loans, you usually have a number of smaller loans that were issued per semester with various interest rates. We are going to look at different repayment paths for $250,000 worth of federal student loans, which include graduate loans, and have an average interest rate of 6%. The first strategy is to pay the loan off and minimize the interest you pay. It's the traditional way to pay off any loan. If the loans are kept in the federal system and enrolled in the default standard 10-year repayment plan, you pay $2,776 monthly over 10 years. In 10 years, you would have paid a total of $333,061. Or, to minimize the interest you pay, say you refinance the $250,000 loan at a 4% interest rate. Your monthly payments would be $2,531 and your total payment would be $303,735. You saved $244 per month, or almost $30,000 over 10 years. Just remember that you can only refinance with private lenders, and you would be moving your loans out of the federal system. This refinancing strategy works well if your annual salary is more than the total amount you owe. The second strategy, to pay as little as possible and pursue forgiveness, is not a conventional way of paying off loans, so the strategy may seem counterintuitive. The results under this strategy can differ wildly because your payments are based on your income, among other things, and not the actual loan balance or interest rate. To illustrate a couple of different outcomes under the federal forgiveness programs, let's assume that you have the same total amount of federal loans of $250,000 at 6% average interest rate, and have a job that gives you a 3% annual increase on your salary, and you stay single for the life of the loan. If you make $60,000 a year at a private company, which means you don't qualify for the Public Service Loan Forgiveness Program, and enroll in the SAVE plan, your monthly payments start around $220 and go up to $503 in the 25th year of repayment. Your total loan balance stays at $250,000, but you would get the whole loan forgiven after the 25th year. So at that point, you would have paid about $105,729 total in monthly payments. One catch is that you may owe federal and/or state taxes on the $250,000 that you got forgiven. If your personal tax rate at the time is 30%, your tax bill on the loan could be over $75,000 that year. So, your total cost for the $250,000 loan could either be $105,729 or about $180,729. Compared to the federal 10-year standard repayment plan, that's still a savings of either $227,000 or $152,000 over the life of the loan. What if your salary and the loans were the same, $60,000 and $250,000 respectively, but you worked for the government or a nonprofit organization? Then you'd qualify for Public Service Loan Forgiveness, or PSLF. In that case, you only have to make monthly payments for 10 years. If you were on the SAVE plan, your monthly payments start at $220 based on your income. You would pay $31,717 total over 10 years, and you get the remaining balance of $250,000 forgiven. Under PSLF, the forgiven loan amount of $250,000 is not taxed at the federal level, so your total cost for the $250,000 loan is $31,717. Let's compare the total cost of loans in each case. If you pay it off on the federal standard 10-year plan, you pay $333,061. If you refinance the loans with a private lender with a lower 4% interest rate, you pay about $303,735. That is about $30,000 in savings compared to the federal plan that had an interest rate of about 6%. If you enroll in the SAVE plan without PSLF, you pay for 25 years with monthly payments starting around $220 for a total of about $105,729 or $180,729 depending on the tax laws at the time of forgiveness. That's a total of $227,332 or $152,332 in savings compared to the standard 10-year plan. If you qualify for PSLF based on your employment, under the same SAVE plan, you pay a total of $31,717. That's a total of $301,344 in savings compared to the standard 10-year plan. Because the amount of forgiveness varies based on your income, tax filing status, and family size, among other things, the calculation for the projected forgiveness amount will not be exact, like it would be in the standard 10-year or refinance calculation. But do you see how vastly different your student loan repayment could look like based on your situation and repayment strategy? Student loans can be super complicated. Always consult with a financial advisor who specializes in student loan planning, such as a certified student loan professional, who can provide personalized guidance based on your specific circumstances. Thank you for watching. Make sure to like, share, and subscribe.